Welcome to Part 3. It's time to get practical. Today we're looking at the actual mechanics and calculations.
Okay, let's dive right in. We're moving from the why to the how, breaking down the precise timeline for capitalizing borrowing costs. We're going to cover the full life cycle here. When to fire the starting gun, what costs actually make the cut, when you might need to hit the pause button, and of course, when you finally reach that finish line.
So, first up, the starting gun. Let's get right to the most fundamental question, right? When do we even begin this process? So, when does that capitalization clock officially start ticking? You might think it's as soon as you take out the loan, but, well, it's not quite that simple. The standard is actually super specific about this and requires 3 things to line up perfectly before you can start. Here are the 3 magic ingredients. First, you've actually got to be spending money on the asset. That's your expenditure. Second, you have to be incurring borrowing costs, the interest on a loan. And third, the real work to prepare the asset has to have begun. The biggest takeaway here, all 3 of these have to be happening at the same time. And that brings us to a really important rule. The latest date wins. It's not the first date, it's the last one. Think about it like this. Say you start paying for materials on June 1st. The loan interest starts hitting on July 1st, but the actual construction work doesn't start until July 15th. So when does capitalization begin? You got it, July 15th. It's only when all 3 of those criteria are finally met simultaneously.
Okay, on to our next section. What costs count? Now that we know when to start the clock, we need to be crystal clear on what we're actually tracking. So let's define what expenditure really means.
Expenditure is a bit broader than just cutting a check. Of course, cash payments for materials or labor are in there, but it could also be you transferring other assets as a form of payment, or even taking on an interest-bearing liability as part of the deal. Now, this is a key point, especially for exams. It's not just about what you add to the cost pile, it's also about what you subtract. Any progress payments you get from a buyer, or any grants you receive related to the asset, those have to be deducted. This is crucial because it reduces the base amount on which you can capitalize those borrowing costs. And what about those necessary activities? Well, it's not just about swinging hammers, it also includes all that technical and administrative work that happens before a shovel ever hits the ground. Things like getting permits or doing the site planning. What does not count, though, is just holding on to an asset, like a plot of land, with absolutely no development work going on. You have to be actively preparing it. All right, Section 3, hitting the pause button. So the clock is running, we're tracking our costs, but what happens if the project just stops? Everything grinds to a halt. You can't just keep capitalizing, can you?
Nope. The standard is very clear on this. You absolutely must suspend capitalization during extended periods when active development is interrupted. And the key words there are extended and interrupted. We're not talking about a quick, minor delay.
And this is where it gets really interesting, because you've got to know the difference between a real interruption and just a necessary delay. So if development is interrupted, say a lengthy worker strike, or you shift all your equipment to another site for a few months, you have to pause capitalization. But if you run into a temporary delay that's a necessary part of the process, you keep going. Think about high water levels for a bridge project or hitting unexpected rock during foundation work. Those are unavoidable hurdles, so you continue to capitalize through them. So the key is whether the delay is an unavoidable part of getting the asset ready or a significant, controllable stoppage. Okay, let's move to our final section, reaching the finish line, because all good things must come to an end, and that includes capitalization. Knowing when to stop is just as important as knowing when to start.
So when do we call it a day? Capitalization stops when the asset is substantially complete
and ready for its intended use or sale. I want you to really focus on that phrase, substantially complete. Because substantially complete is not the same thing as 100% finished. The moment the major physical construction is done and the asset can be used as intended, capitalization stops. Right there. It doesn't matter if you're still doing minor modifications or routine admin work, like finalizing paperwork. Once it's ready for use, the capitalization period is over. Full stop. This also applies if you're building in stages. Imagine a big business park. As soon as one of the office towers is complete and can be used on its own, you stop capitalizing costs for that part. However, if you're building something where all the parts have to work together, like a power plant where the furnace is useless without the boiler, then you keep capitalizing until the entire project is substantially complete.
So, are you ready to manage the timeline? As you can see, it's all about precision. From knowing exactly when to start the clock, to understanding when to pause, and when to finally stop. Every single period really does matter. Now that we've crunched the numbers, refer your textbook thoroughly. Now this is very important for exams. Solve the related illustrations right now and make some notes to make your revisions quicker. Happy studying!